Imagine walking onto a used car lot, spotting the car of your dreams, and then suddenly realizing you have no idea how to pay for it. Do you go for a loan? Do you lease? Do you just hand over a pile of cash? Here is the big truth. Most people in the USA don't buy used cars with cash. They finance them. But the way you finance can either save you thousands or trap you in years of regret. In this video, I am going to break down used car financing for complete beginners, step by step. And stay with me until the end, because I am going to reveal one sneaky mistake that dealerships hope you never find out about. Number 1. Why financing matters. Let's start simple. Financing just means you borrow money to pay for the car and then pay it back in monthly payments, usually with interest. For example, imagine a car costs $15,000. You don't have that amount in cash. A lender, like a bank or credit union, gives you the money and you agree to pay it back over time, maybe 5 years. But here's the catch. That $15,000 car could cost you $18,000 or even $20,000 after interest. That's why financing is such a big deal. Done right, you get reliable wheels without wrecking your wallet. Done wrong, you overpay. Number 2. How car loans actually work. A car loan has 3 main parts: the principal, the interest rate, and the term. The principal is just the money you borrow. The interest rate is what the lender charges for lending you that money. The term is how long you take to pay it back. For example, if you borrow $10,000 at 6% interest for 5 years, your payment might be around $193 a month. But if you stretch it to 7 years, your payment drops, but you pay more in total interest. Lenders make money when you stretch the loan. Shorter terms usually mean you pay less in the long run, even if the monthly payment feels higher. Number 3. Who can give you the loan? You have options: banks, credit unions, online lenders, or the dealership itself. Dealerships love to finance because they make extra profit on the loan. A bank or credit union often gives you a lower rate. For example, if a dealer offers you 9%, but your credit union offers 5%, that difference can save you over $2,000 across a 5-year loan. Always shop around before saying yes on the lot. Number 4. Why your credit score changes everything. Your credit score is like your financial report card. Higher scores usually get lower interest rates. Someone with a score of 750 might qualify for 5%, while someone with a score of 580 might be stuck with 15%. On a $12,000 loan, that difference could be thousands of dollars. So before you even step on a lot, check your credit score for free online. If it is low, you might want to spend a few months improving it before buying. Paying down credit cards, making on-time payments, and avoiding new debt can all boost your score. Number 5. The down payment question. How much should you put down? A bigger down payment means you borrow less, which means smaller payments and less interest. For example, on a $15,000 car, putting down $3,000 up front means you only borrow $12,000. That can save you money in the long run. Plus, it helps you avoid being upside down, which means owing more than the car is worth. Cars lose value quickly, so a down payment is like your safety net. Number 6. Understanding the hidden fees. When you finance, it is not just the car price. Dealers add taxes, registration, documentation fees, and sometimes extras like extended warranties or gap insurance. Imagine thinking you are buying a $10,000 car, but by the time fees are added, you are financing $11,500. Always read the contract carefully. Ask what every fee is for. If something sounds optional, it probably is. Number 7. Why loan length is a trap. Dealerships love long loans because they can advertise low monthly payments. A 72-month or even 84-month loan might look affordable. But here is the trick. The longer the loan, the more interest you pay, and the higher the chance your car breaks down before you finish paying it off. Imagine still paying $300 a month for a car that is already sitting in the repair shop. That's why shorter terms are usually smarter. Number 8. Pre-approval is your secret weapon. Getting pre-approved from a bank or credit union before shopping is like having cash in your pocket. It tells you exactly how much you can borrow and what interest rate you qualify for. It also puts you in control. If the dealer tries to play games with financing, You can say, I already have my loan. For example, if you get pre-approved for 5% and the dealer says 9%, you can either stick with your bank or push them to beat it. Number 9. How to calculate what you can afford. Here is a simple rule. Your total car payment, including insurance, should not be more than 15% of your monthly take-home pay. So if you bring home $3,000 a month, your car payment plus insurance should stay under $450. Too many beginners make the mistake of stretching beyond their budget. Use an online car loan calculator to see how much car you can truly afford before you shop. Number 10. Why you should never skip insurance costs. Your monthly loan payment is not the only cost. Insurance can add hundreds of dollars a month. For example, two people buy the same $12,000 car. One pays $200 a month for insurance, the other pays $120. That's a difference of nearly $1,000 per year. Always get insurance quotes before signing the loan, so you don't get surprised later. Number 11. The dealership financing tricks. Here's the part dealers hope you never figure out. They sometimes mark up the interest rate. For example, the bank might approve you for 6%, but the dealer offers you 8% and pockets the difference. That sneaky little markup can cost you thousands. Always ask, what interest rate did the bank approve me for? Compare it with what the dealer is offering. If it is higher, push back. Number 12. Why refinancing could save you money. Many people don't realize this, but if you got stuck with a high-interest loan, you can refinance later. For example, you buy a car at 12% interest because your credit is bad. A year later, your score improves, and now you qualify for 6%. You refinance, and suddenly your payment drops, and you save hundreds or thousands over the life of the loan. Don't assume you are stuck forever. Number 13. What happens if you stop paying? Here is the scary part. If you don't make your payments, the lender can repossess your car. That means one morning you might walk outside and find your car gone. Repossession not only leaves you without a ride, but it wrecks your credit for years. That is why it's so important to only borrow what you can realistically afford. Number 14. A real-world example. Let's imagine two friends, Sarah and Mike. Sarah buys a $12,000 car, puts $2,000 down, and gets a 5% loan for 4 years. Her payment is about $230 a month. Mike buys the same car, no down payment, and takes a 7-year loan at 9%. His payment is only $190 a month, but by the end he pays thousands more than Sarah, and his car is worth almost nothing by the time he is done. The difference is not just numbers, it is financial freedom. Number 15. The secret tip dealerships never tell you. Here's the loop I promised to close. Dealerships often focus on monthly payment instead of total cost. They will say, we can get you into this car for $250 a month. Sounds good, right? But what they don't say is you are paying for 7 years and giving them thousands more in interest. The trick is to always ask, what's the total amount I will pay over the life of this loan? That one question can save you from being ripped off. Number 16. Why buying less car saves more money. Most beginners get tempted to finance the most expensive car they qualify for. But just because the bank approves you for $20,000 doesn't mean you should borrow it. Choosing a car that costs $12,000 instead of $20,000 could save you thousands in interest and lower your insurance bill too. Sometimes, the smartest move is buying a little less car than you think you need. Number 17. The risk of add-ons. Dealerships often push extras like extended warranties, rust protection, or fabric guard. They roll these into your loan. So instead of paying $500 up front, you end up paying $800 over time because of interest. Before saying yes, ask yourself if you really need the extra. Many of these services can be found cheaper outside the dealership. Number 18. The importance of reading the fine print. Loan contracts are packed with details. Some may include prepayment penalties, which means you get charged if you pay the loan off early. For example, imagine paying off your car faster to save on interest, only to get hit with a penalty fee. Reading the fine print helps you avoid ugly surprises later. Number 19. Why car age and mileage matter in financing. Lenders care about the age and mileage of the car too. A 3-year-old car with 40,000 miles may qualify for better financing than a 12-year-old car with 150,000 miles. Older cars are seen as riskier, so lenders may offer higher interest rates or shorter loan terms. If you plan to finance, choosing a slightly newer car could give you better loan options. Number 20. How trade-ins affect your loan. If you already have a car, trading it in can lower the amount you need to finance. For example, if your trade-in is worth $4,000 and the car you want costs $14,000, you only need to finance $10,000. But here's the warning. Dealers might offer less than your car is worth. Always check the value of your car online before accepting a trade-in offer. Number 21. The danger of rolling over negative equity. Some buyers still owe money on their old car when they trade it in. If you owe $8,000 but your car is worth $6,000, the dealer may roll that $2,000 difference into your new loan. This is called negative equity. It means you are starting the new loan already behind. That can trap you in a cycle of always owing more than your car is worth. Number 22. The power of making extra payments. Even small extra payments toward your car loan can save you a lot in interest. For example, paying just $50 extra each month on a $10,000 loan at 6% could shorten the loan by nearly a year. If your lender allows it, this is a smart way to get debt-free faster without refinancing. Number 23. Why your debt-to-income ratio matters. Lenders don't just look at your credit score. They also check how much debt you already have compared to your income. If too much of your paycheck is going toward credit cards, student loans, or other debts, they may give you a higher interest rate or deny the loan altogether. Paying down other debts first can make your car financing easier and cheaper. Number 24. How timing your purchase can help. Believe it or not, when you buy matters. At the end of the month or year, dealerships often have sales goals. They may be more willing to negotiate on price or offer better loan terms. For example, shopping in December could land you a better financing deal than shopping in June. Timing can save you real money. Number 25. Why not all lenders are equal. Some lenders specialize in subprime loans for people with low credit. While they approve more buyers, they often charge sky-high interest rates. A loan at 18% can double the cost of your car. Just because someone says yes doesn't mean it's a good deal. Compare offers before you sign. Number 26. The importance of gap insurance. If your car gets totaled in an accident, regular insurance only pays the current value of the car, not what you still owe. Gap insurance covers that difference. For example, if you owe $12,000 but the insurance payout is only $10,000, gap insurance covers the extra $2,000. Without it, you'd be stuck paying for a car you no longer have. Buying a used car should not feel like walking into a trap. Financing can actually work in your favor when you understand how the system works. You now know about interest rates, loan terms, down payments, dealer tricks, and even refinancing options. The next time you shop, you'll walk in with confidence instead of fear. So here's my question for you. If you had to choose right now, would you go for a shorter loan with higher payments but less total cost, or a longer loan with smaller payments but more interest in the long run? I'd love to hear your thoughts in the comments.